Welcome to the Nicholas and Tally Show, where we chat with entrepreneurs, experts, and entertainers to help you live a more fulfilling life and take your business to the next level. Today, we're chatting with Jeremy Schneider. You may remember Jeremy Schneider from episode 50, where he taught us the exact process to becoming a millionaire. Jeremy is back to help us break down what's going on with all these banks collapsing. Jeremy is the founder of Personal Finance Club. Personal Finance Club gives simple, unbiased information on how to win with money and become a multi-millionaire. Before we dive in, I have a little treat for you. Are you looking to launch or grow your own podcast? Do you want to rub shoulders alongside the best leaders in your industry? How about turning your podcast into an absolute content machine? Then look no further. You can apply to work with me through the link in the show notes. I'm looking for 5 driven entrepreneurs that are ready to create a high-quality podcast that will engage your target audience as well as strengthen your brand and social media presence. So if you're ready to take the plunge, schedule a free consultation with me today by hitting the link in the show notes. Riddle of the week: why are elevator jokes so classic and good? Stay tuned to the end of the episode to find out. That was the intro. Now here is the episode.
Hey, Nicholas. Thanks for having me back. Apparently it's been years. It feels like it's been a month.
I know. Time is moving swiftly. But we're not going to waste any time here. We're going to jump right in. We're diving head first into this. We're talking about the banks collapsing. Can you explain the collapse of the Silicon Valley Bank to me as if I were a wee 5th grader?
I cannot. Just kidding. I'll do my best to understand, to explain it. I think at first it's important to understand how banks basically work in the US, which is they don't just take money and put it in their vault and sit on it like a dragon on a pile of coins in a dungeon or something like that. They take all the money and then they do stuff with it. So, for example, what this is called has a fancy sounding name, which is called fractional reserve banking. Fractional meaning part of their money. So they don't keep all their money, they keep part of it. Reserve means the only part of it is in reserves, like isn't that cash. Then the rest of it they do stuff with. And in the US, I think that number is 10%, which means they only really need to keep 10% of the cash deposits they have on hand. So let's say you, me, and a bunch of other people deposit $1 million to a local bank. That bank only needs $100,000 in cash to be made available to the depositors at any given moment. The other 90%, they do stuff with, like they can give it out as loans, they can buy bonds, they can make other investments. And the idea is, with all the day-to-day operations of a bank, deposits, withdrawals, that 10% is big enough cash buffer to handle those. And then their investments are making money and maturing and getting reinvested over time, creating profit for the bank. And then as individual depositors, we have a safe place to put money. And then the bank has a business model, which is they can, use that money to make money and still provide us all of our banking services. That works great under normal scenarios where people are depositing, withdrawing at normal rates. But if there's a run on the bank where basically people all try to take their money out at the same time, and they need more than that 10%, it creates a problem because they don't have it and they need to do something like sell their investments prematurely. And so what happened with Silicon Valley Bank is essentially that. And it was a little bit strange, I think the overriding question is is this going to be a systemic issue or is this just like a weird thing? And I think that they were weird for a few reasons. One is that they basically only had one type of customer, which was like these huge, fast growth Silicon Valley tech startups. And also they were making some bad decisions with that 90% of the money they're investing. And so what has been happening the last many years was these Silicon Valley tech startups were getting huge venture capital investments, getting checks from these rich people for millions of dollars, putting all to Silicon Valley Bank. Silicon Valley Bank was like, oh my gosh, we're doing great. We keep getting more and more money. We can keep investing this money. And they bought a bunch of bonds. And bonds were paying like 4 or 5% per year, but they take years to mature. When you buy a bond, you're basically agreeing to a term. So like the Silicon Valley Bank would give the US Treasury millions of dollars and say, hey, you can keep that for 10 years. And in 10 years, we'll get all of our money back. We're guaranteed to get 100% of our money back. And along the way, we'll just get that 5% interest. What happened at Silicon Valley Bank was rates started going up. So interest rates started going up, which meant that a few things. One, venture capital was drying up. So that means these tech startups, I know this is kind of getting in the weeds. Maybe this is more like a 6th grader than a 5th grader. All right. Yeah. All right. But so venture capitalists were writing less checks to the tech startups. And so instead of this huge influx of cash into Silicon Valley Bank, the opposite started happening, which is those Silicon Valley tech startups were slowly withdrawing money, which alone isn't a big problem. But also interest rates going up means that those bonds that the Silicon Valley Bank had purchased, if they waited it out for 10 years, they would get all their money back. But if they needed to sell that money, they sell those bonds prematurely, the price of those bonds temporarily goes down. Temporarily meaning in the interim before the 10 years in this example is up. Because maybe the new bonds are paying 6% or 7%, and so no one wants to buy one of their old 5% bonds for face value. They're going to pay less for it in order to get their 6 or 7% return they could get from a new bond. So when interest rates go up, the price of existing bonds falls. So what happened was Silicon Valley Bank was in this slightly uncomfortable position where they're like, ooh, money is starting to flow out instead of flow in, and our bonds are worth less. They're like, hey, let's like get some more cash. We're just going to like sell some shares of our bank. And that would have been fine. They would have sold some shares of the bank. They would have had cash. Nothing crazy was happening. But then what's crazy happened was basically a few of these Silicon Valley tech guys were on like a group chat thread. Essentially, I don't really know if there's a text or whatever, but word traveled very quickly. They're like, hey, Silicon Valley Bank might be in trouble. Just like the rumor started. Silicon Valley Bank might be in trouble. They're selling stock to raise cash because who knows why. Let's be prudent companies and take our money out.
Yeah, let's get out of there.
And so then that 10% buffer they had, suddenly, I forget the number, but it was like $60 billion of withdrawals within like 24 hours or something like that, because just like the dominoes started falling where, the word spread like wildfire among these like very small group of like high deposit tech companies out in Silicon Valley. The money started flowing out and it was like a span of like 48 hours from Silicon Valley Bank being like, we're in a slightly uncomfortable spot. Maybe we should raise cash, to them failing and saying, we don't have enough money. Because when all that money tried to go out, they ran out of that 10% fractional reserve that they had. Then they had to start selling their bonds at a loss because rates had gone up. And then they were like, uh-oh, we're in a position where we can't give everyone their money back right now. We could wait it out for 10 years or something, but that's not how banking works. The whole point of banks is that you can take your money out whenever you want.
Yeah.
And so that is... And then what basically happened was, once a bank fails in the U.S., we have this thing called the FDIC, the Federal Deposit Insurance Company, I think is what it stands for, which yeah, sounds reasonable, right?
Yeah.
And then they're like a federal agency, which is their job is to basically add security to the banking system. And so they basically step in, take over the bank, and they actually insure depositors, which is what normally gives all of us confidence in the banking system. They guarantee the U.S. federal government guarantees you get your cash out, but they only guarantee up to $250,000 per depositor, which for you or me are normal people who don't have millions of dollars in cash, just sitting there cash doing nothing in the bank. Even millionaires don't have millions of dollars of cash. They have investments, real estate, whatever. But these tech companies did have cash because tech companies were spending the cash. And so it turns out that, a normal bank, maybe 70% of their deposits is insured, and then there's a few millionaires who do have over the $250,000 that makes up the other 30%. But in Silicon Valley Bank, only 3% of the deposits were insured, meaning 97%. And so all these weird things where it's like all Silicon Valley companies that were talking to each other, the bank doing some weird thing with the bonds, the nature of venture capital, which was flowing in, then flowing out, and then this really high depositories, which meant very little of it was deposited. All this combined into this weird 48 hours where the bank failed. That's what happened. Sorry if that was too hard for a fifth grader.
That was exactly what I want, and a fifth grader can't understand that, and then they gotta go somewhere else. This is real deal only.
Yes. Sorry, fifth graders. All right, we didn't even start small. Okay, cash, you put money in, take your money out.
Yeah, head to recess. It's super fascinating. It is kind of like the perfect storm, really, when you think about it. One of the questions that come to my mind, though, is in an instance like this, I think the temptation is to ask, well, shouldn't they be required to have more than just 10%? You're putting 90% elsewhere, and if it's really not their money, shouldn't they be more prepared for something like this, catastrophic? Do you think there should be more oversight on the 10%? Should it be higher? Should it even just be just a set in stone number like 10%? What do you think it should look like?
All those questions are basically above my pay grade. I guess I would answer with there are pressures on both sides of the equation. I think some of the headlines now are pointing out how Silicon Valley Bank, their CEO, was like lobbying Congress several years ago to reduce the restrictions. The banks, in theory, would prefer to have no restrictions, and they decide what their fractional reserve is. They decide how aggressively they can invest the money, because they want, they think they know better than the regulators. And so, is 10% enough? Not in this case, apparently, but like let's say it was like 90% or something like really intense.
Man,
and then I think banks would be like, okay, well now we're going to go out of business because we can't afford to have bankers and have physical locations and have websites. We can't afford to do that if we're just sitting on your cash, right? Or it would dramatically change the nature of the banking industry, where if you want to open up a savings account, they might charge you $100 a month to open up a savings account, and suddenly normal consumers can't use the banking system because that is prohibitively expensive for small consumers. And so there's pressures on both sides of the equation there. And it's above my pay grade to suggest what that number should be or how that should be run.
We'll have to get a middle schooler involved, really even out the playing field on this knowledge discrepancy.
Bring the 7th grade guest on. He'll be able to, he'll answer those questions.
Touching on the FDIC insurance too, I think there's also, it's a similar question of, should the FDIC do more of like a percentage-based thing instead of just a $250K flat rate, like the SVB people that have their money in there? If the majority of them are above it, maybe it should be a percentage of whatever they have in the bank, or maybe a balance average instead of just being like $250K, that's all you get. And if it's above that, sorry about it. And I'm also curious, like, this seems like it's going to have some repercussions. All of these people that are going to take years to get their money back and things like that. How's that playing out from what you've seen?
I think I just tried to mute and clear my throat and did not mute correctly, so that might have been it. But these do have have separate tracks, right? So maybe you can clear that. Although now that I've explained it, you might need to leave it in so people know why I'm coughing. Okay, maybe
I'll add my own.
All right,
though.
So maybe
I'll probably go ADR, nice cough for you. There you go.
Yeah, add a real big phlegmy cough. So yeah, the $250,000 number is weird because it's like, why that number? Why not 100%? Why do they do it at all? And so I think the reason they do it at all is because if consumers aren't confident that their money is safe in a bank, then we don't use banks, and then we're like an unbanked society, and we lose the ability to produce mortgages and loans, and we lose the ability to buy houses, and it like basically it sends the economy like throttling backwards, and we're like almost like bartering, and and we don't have like a modern blossoming economic leading economy of the world. And so the government has stepped in and said, hey, normal people, we have the biggest military on the planet, and we decide how much money gets printed. So that's a pretty powerful combination to say, we promise you up to $250,000, you're gonna get your money back. And so like I said, normal people, even millionaires, like my net worth is $4.5 million, and the amount of money that I have in cash in an FDIC insured account is maybe like 30 grand or something, which is even kind of a lot for me. I just don't like a lot of cashing around. I like my money invested doing things for me, which means it's not in cash. And this whole fractional reserve banking FDIC thing no longer applies. We can talk about that a bit later, I think. So then it would say, okay, well, why not just insure all of it? Why not say, hey, and actually that is what happened. The FDIC came in this time. They're like, hey, this is the first bank to fail. In 2008, lots of banks failed, and that was very bad. So we're just going to say, hey, every single depositor at SVB will be made whole. We've made a decision to do 100%. They could theoretically say that for every bank, but then I think that kind of incentivizes banks to be even more reckless,
Yeah.
If banks don't have their own skin in the game to fail and make their depositors angry, then they might even be more reckless. And so this random number of 250 came along. Of course, I think there's also maybe some onus put on businesses saying, hey, if you're putting millions of dollars into a bank or hundreds of millions of dollars in the bank, like many of these tech startups were doing, you should check out that bank and make sure they're good. And like, let the free market decide, like, you put your money in the safest banks, and therefore the banks that are not being reckless with their money are going to draw more deposits or whatever. The problem with that is just that, even when you talk to these massive startups, like, they're not really, everyone who's a Silicon Valley bank does as much due diligence. They're not like combing through the bank's balance sheets and doing stress tests based on theoretical Russian wars and rising rates and coronaviruses and things like that. They're just blindly putting their money in like the rest of us are. And then the other piece is like the regulators. So shouldn't the regulators be doing it? And like they are. And I think that kind of goes back to how the SVB CEO was what's the word when you go to Congress and you ask them to do something?
Plead.
Lobbying, yeah.
Beg.
Yeah, plead. Lobbying against the regulators. So there's all these pieces, and it didn't work in this case. What was the other question you asked?
I don't know. I threw a lot at you, but I think that's a good jumping point. The SVB, it was on like the best bank list, like top 20 bank list for like 5 years in a row or something. It's weird. Oh, I think the next question around it was like the repercussions, because even though it's insured 100% and people are going to get their money back, they're not going to get their money back today. You know, it's like, don't they have to sell the bank's assets and like get everything liquid again and then disperse it? There's time in between of when they're going to get their money back. So I'm like kind of concerned that all of these banks that had, or all of these companies that had their money in this bank, are they going to survive? They had all their money in the SVB bank and now it's going to take too long for them to get it and they go under. It seems like it's going to have like a rippling repercussions.
The answer is I don't know. I don't think any of us know. I mean, I think that there are probably private conversations. Planet Money, the podcast, has done some great shows on this, and they've even had some, like, they've aired some private conversations among these tech companies that are. Am I allowed to shout out other podcasts on your podcast? Is that like a poor form? All right.
I suppose we'll allow it.
Okay, they've aired some like private conversations, not private conversations, but like employee internal conversations where these tech companies are like, all our money was in SVB and payroll's on Friday. We have a 48-hour kind of issue because when you don't make payroll, that's basically when you go out of business or, you know,
yeah, you're done.
You're in very dire straits. And so they're like trying to get some money out of SVB. They're trying to go to their investors and say, hey, can you just give us a temporary line of credit? I'm an eternal optimist, and I just think there's enough wiggle room in the system that, and the fact that the FDIC has said that they're going to make everyone whole would give faith to those types of bridge loans or lines of credit that, you know, we're not going to see like Roku. Roku famously had like $250 million or something in, maybe not that famously, but I think Roku had like $250 million in SVB. They're not going to go out of business because of this. And also Roku had like 4 banks. I think they were basically putting them equally in each one just as some level of redundancy. And so they basically had $1 billion in cash and they're down to $750 million. And so, you know, I think they're not going to have a payroll issue or anything, and then they're going to get their money. You know, there might be some other companies or smaller ones that just only had one bank account that are going to have a uncomfortable situation either with investors or their employees for a while. But I think that we'll get through it. You know, we got through 2008, which was dramatically worse than this.
Agreed. What's the role of the Federal Reserve? Tell me how they play an impact in all of this, because they seem like they've been pulling some strings. They've been making some things happen. And I think a lot of investors have been blaming the Federal Reserve for all of their changing of the interest rates. And so I guess let's start with like, how does the Federal Reserve interact with these banks and play their part?
So the Federal Reserve is the central bank. It's like the U.S. bank, and they have a few jobs. One is they like make monetary policy, like they do the regulation, they make the rules about banking. They also act as like a lender of last resort to banks, so they like give out their money sometimes if they need to, and they also notably set the rates. And so I feel like their tools, they definitely get a lot of pressure from everyone being like, why is the economy doing this? Or why are you making the market do this? And the reality is they basically have one very blunt instrument, which is the interest rates. They can raise the rates or lower the rates. And what that means is basically saying they decide how expensive it is to borrow money. And if they make it more expensive to borrow money, then people can basically buy less stuff. It's harder to buy a house. It's harder to get out a loan to run your business. And that generally slows the economy, which businesses hate. They're like, hey, make it cheaper to borrow money so we can, you know, even as an individual, you know, like if you're trying to buy a house, when mortgages were like 2.something%, when a house went for sale in my neighborhood, they literally like hired security to like, you know, prevent the open house from getting out of hand because people are trying to buy the house so bad. Now the interest rates, now that mortgages are like 6 or 7%, I literally have realtors knocking on my door begging people to come to the open house. It's wild, like what a stark contrast that like a year made in the real estate market. And so that slows the economy. Fewer houses sell, prices go down, businesses do less business. And so you'd say like why would they ever want to slow the economy? And the answer is inflation, because inflation has been going crazy. And why is inflation going crazy? You know, lots of reasons, in my opinion, largely because COVID happened, and then governments around the world to start printing money like crazy to try to like keep people from becoming like broke or whatever. And then there's all this new money, and then people were like, oh, I got all this like free loans, free money, whatever. Then they started buying houses and buying goods, and then businesses had supply chain issues, and so they just started raising their prices, and then it kind of became a self-fulfilling thing. It's like everyone thinks there's inflation, so there is inflation. And so then, meanwhile, the Federal Reserve, which has like one lever, like push rates up, push rates down, they're like trying to drive this like massively complicated economy like through this like obstacle course with like one button they're pressing, getting a lot of the blame when it's obviously a complex issue. That's the role, and they were raising rates very aggressively because I think hyperinflation is probably the worst thing that could happen to the U.S., where we could say the dollar becomes valueless and other countries and don't trust it and we don't trust it. And so when we started seeing inflation creep up to 10%, the Fed just took their one lever and like put it full throttle. But then, of course, Silicon Valley Bank failed, and they're like, oh, if all the banks fail, then they're like, and so we just got. After the SVB failed, the Fed just came and gave their most recent update, and they did raise rates again. They've basically been aggressively raising rates by like 0.5% or 0.75% like every single chance they get. This most recent time, they raised it by 0.25%. So it's still going up, but slower. And so, that's where they fell with their one tool.
Yeah, it seems like a very delicate system. Like everything is relying on that one lever. I also love the idea that people are getting rowdy at open houses. That was an interesting little tidbit that I did not anticipate.
Oh yeah, I mean, if you try to buy a house in like the end of 2021 and you went to an open house, there'd like you'd be getting like people were like cramming their way through the door and like just giving all cash offers or what, it was crazy. And then end of 2022, like a year later, crickets, price drops, market prices on the market forever. So it's really interesting how dramatic of an effect those rates can have.
Yeah. Saw this yesterday, so hopefully it's true. Somebody can fact check me. Is 63% of the loans that are out right now for mortgages are between 2 and 4%, and 28% of them have a rate below 3%. So the housing market, in comparison to what the Federal Reserve is doing to these interest rates, nobody wants to sell because they have a sweet deal.
Right.
So it's interesting to see how things are going to continue to play out because it's so delicate.
Yeah, I know. These ripple effects, back when rates were 2%, it was like, hey, free money, free houses. But now it's going to definitely be weird for the housing market because anyone who's locked into a super low rate like that, if they move, they'd have to get a really high rate loan and they have to like downgrade their house or whatever. And so it's just going to really kind of constrict the supply of houses on the market. But that will, normalize over time, but it might take years because as those loans mature, people pay off the loans or eventually have to move or whatever. There's going to be less of that. But right now it's kind of the most stark because rates went up really fast and everyone just got a good loan a few years ago.
I wouldn't want to sell. I'd want to hold on to it. 2%. Free money. Do you want to dive into credit default swaps, our favorite topic of conversation, and how those are affecting the state of banking? It seems weird that the main example I saw was with Credit Suisse. Do you want to lay it on me how credit default swaps can kind of play into this? Because I suppose there's more speculation around potential collapses because of this.
Full disclosure, like my expertise is as a consumer investor educator. And so credit default swaps are just not something normal people deal with. It's like it's like a derivative, which means like a contract between two banks or something that is based on something else, and they trade for whatever reason they trade. It's like very like macro big bank kind of thing. But basically, credit is a loan. Default is when you don't pay a loan, and a swap is basically selling the risk of that happening. And so if one bank has given out a bunch of loans, like mortgages for houses, and then they're worried that those loans aren't going to get paid, they can like sell the risk of, or they can buy or sell off some of that risk and pay some more money to some other bank, and some other bank can be like, okay, I'll share this risk with you and get some payment from it. And then it just creates these like complicated scenarios. So when it does fail, like it affects multiple banks or whatever. My reading on the Credit Suisse thing is that it wasn't based on credit default swaps. It was based on just like a more, incremental thing of they had gotten
losing
some legal
cash and all the lawsuits. Their stock is like down 93% since their peak. They seem like they're going through it.
Yeah, and they just got bought by UBS, right? They were basically forced to sell to their biggest competitor for half of their I think it was something like $2 or $3 billion, which I think is like a tiny number compared to what they're valued at a few years ago. But yeah, I think, their story is like kind of like Silicon Valley Bank, but just a different set of circumstances, where they are a Swiss bank that is like, has always been world renowned for super, super safe, super, super boring, super, super secure. And then they kind of got into some
shady,
messy stuff. Like they were doing some illegal stuff or something. And then suddenly all the confidence in their bank started to dwindle. And so then the money started to flow the other way. Some big deposits came out, and then like the U.S. was issued some sort of inquiry into their most recent report, which delayed it, which made people even more concerned. And then they basically had that same situation where they're like, oh man, we're not going to be able to cover all these deposits as they're flowing out. And they went to their Swiss regulator for help, and then the Swiss regulator basically forced them to get sold to UBS. And I think that's where it's at right now. You're right. It's a very weird space, because you're like, is the whole system made up? And the answer is, yeah, the whole system is made up, right? Like what's not made up is like, we could have been Neanderthals, like in caves, like hunting and gathering. And we've like built this confidence in this societal agreement. And you have to take this like very abstract look, and you're like, is this all made up and could it all go away? And the answer is like, yeah, theoretically, but I think it won't, as long as there isn't some sort of like global nuclear fallout or meteor that just demolishes. I think there's just enough interest among people who have money and power to keep the system going, but still is interesting.
It's strange. It does seem like there's enough fail safes, I believe that's the term, in between like the point of just complete and utter shattering everything in every bank across the board. Probably won't find ourselves in something like that, but like a couple more banks could go down, but not to the point where we're like throwing hands in the street for a loaf of bread. At least hopefully not.
That's true. Here's a trivia question for you. Between 2008 and 2012 in the U.S., I mean, you won't know this, okay, but I think it's really funny to like talk about now. So between 2008 and 2012, basically covering all the time of those bank failures, how many U.S. banks failed?
It's like 435.
That was an insane guess. It's 465. I thought you were guess like 12 or something. That was amazing. Who knew there were that many banks? Because like you hear about SVB, which like frankly, like who has heard of Silicon Valley Bank before a week ago? Like just tech companies, right? And then there's like another one in New York that I forget which one, but there's like a couple, and so like 465, right? So like that was crazy, and like we figured it out, and like the government basically like shouldered, and it was like ugly for a while, but still from a consumer's perspective, like I'm old enough to remember that I was 28 to 31 during that time, and I was running a company, and whatever life went on, I don't remember like not being able to like get my deposits or anything. I was making payroll. So I think it's important to like remember historically, because I think people get really anxious about current news, but if you look at previous news, so much bad stuff has happened, like world wars and like great recessions, and we talk about like 8 and 9%, like inflation's at 6% now and falling, and it like peaked around 8 or 9. We've had like 25% inflation. We've had 20% rates. We've had oil shortages. We've had, world wars. We've had like so much like bad stuff, and we get through it. And so I think that's important to remember that is still going to happen this time, and we'll get through it. And this weird SVB Credit Suisse thing is not going to be what sends us into the Stone Age, and it's probably still not time to be collecting like canned goods and shotgun shells so you can live in the woods or whatever. Yeah,
the headlines are almost scarier than a lot of the impact that it has on our day-to-day lives.
Oh, 100%.
Just reading those.
If you don't read the headlines and you're just worried about saving money and investing along the way, then you'd be doing great.
Have you seen it's more of a meme than anything. I wish I was like, the biggest financial mistake I ever made was being too young or unaware of the recession to buy up all the homes in 2008, things like that. This could be our 2008. Maybe this is just our opportunity.
No, that's a really great point, because I think people are saying, oh my gosh, should I be pulling out of the market, or should I be stop investing or whatever? And the answer is like, no, the opposite. Like this is the opportunity. Like the market has basically been down since the end of 2021. We're down, I think, 15% from all-time highs or something like that. So yeah, buy it up. This, in my opinion, what's likely to happen is once we get past all this uncertainty, the market's going to pop off. Like right when, I feel like there's this like, people are like afraid of like, oh no, it's going to fall more. I'm like dude, it's about to pop off. Once we've been afraid, which is why it has been falling. But as soon as the Fed decides to start lowering rates, as soon as the banks thing all seems to stabilize, like as soon as that all happens, which it will, then the market's gonna be like, all right, get on board. And and the thing is, like, by the time that happens, it's too late. You have to own it before. And so this is when you should be like buying up those, those opportunities.
Confidence and perception is so fascinating in things like this, because the whole bank collapsed just because people were like, I don't think, maybe this isn't the right thing, and just pulled all their money out. So it's crazy how perception of how things are actually playing out and our belief in them swayed so much things in the economy. I do want to bounce over to how brokerage accounts are differently set up. Is there fear? Do you have fear around what would happen to our brokerage accounts or stock brokerage accounts if something similar happened, or Vanguard went under, or Fidelity went under, or something like that?
So this is really interesting. I think it's really important to understand the distinction here, because with banks have this fractional reserve banking system we talked about, where they only keep 10% of the cash, 90% that they take your money, and then they go do stuff with it to their own benefit. But that's not how brokerage accounts work. And so when I said earlier, only of my $4.5 million net worth, only $30,000 is in cash, the other $4.5 million or so is invested. It's either in my physical real estate, my home, or it's in stocks and bonds. Index funds is what I buy. And so when I go to a brokerage like Vanguard, Fidelity, or Schwab, and let's say I put $100,000 in and I buy $100,000 of an index fund, what that means is I put money into this fund, which buys all these underlying stocks. But there's no fractional reserve investing. It's not like they're taking those stocks and then doing stuff with it. Like, I own that. And they're kind of doing more of like what I talked about with like the dragon on the pile of gold coins. They're just holding it for me. They're just managing it. And they don't make their money by taking the cash and doing stuff with it. They make their money through fees. Like, there's a fee on that index fund. They charge a small percentage of the money that they take out every, it's like the dragon who's protecting it just like takes a few coins and eats them, or whatever dragons do with coins. I don't know if this dragon metaphor is going off the rails here.
Yeah, could be.
And so with the FDIC, if the banks fail and like their whole fractional reserve thing didn't work out and they didn't have put enough cash, the FDIC has to come in and like just put more new money in there to make everyone whole and sell off all the assets or whatever. With a brokerage account, that doesn't happen because all those shares are there. And so, like, let's say I was investing with Fidelity and I bought an index fund with Fidelity, and then Fidelity went out of business for whatever reason. Those companies that I bought still exist. I still own shares of Apple and Amazon and Netflix and Google and all that stuff. And what would happen is basically I would just need to find a new custodian, a new brokerage to basically help me manage this, because I'm not going to like take ownership of the shares directly. And so there is no FDIC insurance on investments because it's not cash, so it doesn't make sense. But there's this other type of insurance called SIPC insurance, which basically protects you not against the cash not being there, because that doesn't exist, but it basically protects you against fraud or other weird stuff that would happen. So if like Fidelity was committing fraud and didn't actually own the shares and they're lying to us or something, they would step in and basically make you whole to give you confidence in the investing economy or the investing market. But it's a different type of insurance, and it also is why I don't worry about banks collapsing, because I don't have that much cash, and I would worry about the whole economy collapsing and the stocks I own to be worthless. But I don't see that as a credible threat, because if that were to happen, then you couldn't even go to the grocery store because there would be no more economy. There'd be no more. Yeah, the world's on fire, and that might happen. I don't know, but if that happens, like, we're beyond the problems of the SIPC and we're like into shotgun and canned goods territory.
I was actually pretty reassured when I found that the SIPC covers up to $500K if something is lost. Charles Schwab insures up to $1.5 million, but really it's just finding a new home for your investments. I was almost like, this is better than the banks. If I'm not trusting the banks, if I keep it in this other account, then I wouldn't even have to worry about it because it's all mine. I think I also like the fact that there was like you're saying, they are not messing with your money and your stocks and those things. It's like completely separate. Whereas the banks, it's like a big pool of money and some of it could be yours and some of it could be other people's. I like that it's separate.
Yeah. No, I mean, I think there's like a certain type of doomsday scenario person who would feel the same way, maybe for different reasons, but they'd say, yeah, don't keep your money in cash, keep it in gold, keep it in physical assets. Like, don't, cash is just this made up fiction from governments, own companies, own real estate.
It's just a piece of paper.
And so there's something to be said. I don't really buy that necessarily. Like I think the banking system is strong and will continue to be able to transact using cash, whatever. But I think a better argument for it is that cash doesn't do anything for you. It just sits there. Like it's tools to be used. It's a tool to be transacted with to keep track of who owes who what. But once you're accumulating it, you'd rather have that money doing something for you, like in an investment, like in a piece of investment real estate where a renter's there paying you rent, or in stocks, owning companies of the world that are out there doing business and then paying their profits back to you in the form of dividends as just cash payments while you own them, or in terms of rising share prices. And so I think whatever, maybe you disagree on why, but I think the concept is strong that, you just don't want to have tons of money sitting in cash. You want to have a little bit for an emergency and stuff like that, a few months of your expenses ready to be used as necessary, but the rest should basically be going to work for you.
What would you say if I wanted to just suck at money, managing my money? If I just wanted to be terrible with my money, what would your advice be to be horrible with it? How could I do the opposite of getting wealthy? I
mean, there's a ton of good ways. And it's almost everything that people naturally do, which is the first thing you do is just spend beyond your means. So spend at least all of your money, and hopefully more of all your money. Someone's going to clip this and be like, Jeremy's lost it. And
it's gone off the rails.
Yeah. And the way you spend more of all your money is you borrow money. And so, I would go get a credit card and I would max it out on stuff that either is just consumed or plummets in value, like cars and boats and stuff like that. Cars and boats plummet in value and produce liabilities. So if you borrow money for cars and boats, you're going to just be hugely negative. And then with any other cash you have, if you want to be even worse, you could basically do speculative gambling, things like buying crypto or options. Options are basically betting on the stock market. Is essentially like gambling at the casino. And as I say this, it's funny because people do this, and people even suggest it as a good idea. They think they should be buying boats because that's what rich people do. So they go borrow money to buy a boat, and then with any extra money they do have, and then you just get in this situation where you're just underwater. You can't even make your debt payments. You've lost money in the markets. There's just like at a casino, it's possible to win short term, but when you're gambling and you're borrowing money and you're paying money to the banks, you're just going to get burned long term. And so, that's what I do. And if I wanted to lose money, and if you want to make money, just do the opposite. You don't borrow money, you spend less than you make, you invest in reliable things like index funds and real estate. And then, it's less exciting because on any given day, it's not like you're driving a boat and watching what Dogecoin's going to do. But fast forward 10 years, you might be a millionaire, and Dogecoin boat guy, like his boat got repoed and he's working just to make minimum payments on his debt. And that's like pretty stressful 10 years for him.
RIP. Man, that's pretty bad. Jeremy, we are rapidly approaching the final question of the podcast. Before we do, I want to acknowledge you for all that you're doing. I'm excited. I look forward to having a conversation soon around the Personal Finance Club journey. I love the content you put out. This. I have tremendous amount of respect for you. I think you're a super brainiac guy. And I really like how you connect with people with where they're at, help them get through their money issues and educate them moving forward. So thanks for all that you're doing, Jeremy. I appreciate it.
Thank you, Nicholas. I think you're doing a great job too. I'm really proud of your podcast growth. Last time we had this call, you were in a van down by the river, and now you have some sort of house from what I can see.
Look at us. Growth, baby. Where can people find you on the internet? That's the last question. Just plugging your stuff. Let it rip, Jeremy.
Yeah. The brand is called Personal Finance Club. We teach the basics of personal finance and investing, how to build wealth. None of the skeezy, scammy nonsense. It's just what's a stock, what's a bond, what's an index fund, what's a mutual fund, what's a Roth IRA, how do all these things work, how to optimize them. And personalfinanceclub.com. Instagram is where most of the magic happens, at Personal Finance Club. We're on the Tickety Talks, YouTube, things like that.
Awesome. All those links will be in the show notes. Go say hello to Jeremy, follow him, like every single one of his posts. All of them. Don't leave a single post left behind.
We're 1,000 now, so you'll be there for a while scrolling.
Take an afternoon and get to it. Jeremy, thanks for being on the show.
Thank you, Nicholas. Great to see you. Bye.
That was the episode. You just listened to it. Don't forget to leave a 5-star review on Apple Podcasts and Spotify. Share this episode with a friend that you appreciate. It'll take 5 seconds and it is a great use of your screen time. Also, if you'd like to work with me, the link to the application is in the show notes. Would love to chat with you, do a free consultation, and see where I can help you in your podcast journey. The real reason you're still here, you want to know the answer to the riddle of the week. Why are elevator jokes so classic and good? Because they work on many levels. Yeah, yep, they do. They sure do. They work on many levels. Thank you for tuning in. New episodes every Friday at 6 a.m. Since you're here, though, if you enjoyed this episode with Jeremy, listen to him talk about his bread and butter investing strategy in episode 50. Go back and listen to it. It's a fun listen. Be kind, be strong, be disciplined, be obsessed. See you soon. Bye.